David R. Guttery is the Chief Executive Officer of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Ameritas Investment Company, LLC, and Ameritas Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, CEO of Keystone Financial Group in Trussville, to share his thoughts about the 5 utilities of life insurance. David, thanks so much for being with us today. Well, kind of thrown us a curveball this week. You always seem prepared to discuss the Federal Reserve or the Magnificent 10, so this topic is catching me a little off guard. You've spoken in the past about comprehensive wealth management and what that looks like. So what thoughts are you going to share with our viewers today about how life insurance factors into a comprehensive wealth management plan?
Yeah, well, sometimes it's good to be unpredictable. To your point, yes, since our last video, we did indeed receive the first discount rate cut in nearly a year from the Federal Reserve, and markets are seemingly anticipating another one, possibly 2 rate cuts before the end of the year. We'll have to keep our eyes peeled on economic metrics between now and then to anticipate what the Fed might do next. Today, I wanted to talk about life insurance for a minute because, well, it is National Life Insurance Awareness Month, and I thought that the timing was appropriate. So let me begin by saying that at the conclusion of this video, I hope that your viewers understand life insurance to a much greater degree, because personally, I believe it's one of the most underutilized and one of the most misunderstood tools. So stay tuned to learn why I believe that to be the case. Today, I wanted to talk about the 5 utilities of life insurance. Most people think of life insurance as being only about a death benefit, but it is so much more than that. Sure, it's a tax-free sum of money that a survivor can use to satisfy a mortgage. Absolutely. When considering the death benefit utility of life insurance, however, most people don't consider how this can be a replacement of someone's economic footprint. More on that in just a minute. Life insurance can also be a surrogate for traditional long-term care insurance. It can be used as a tax-favorable silo of safe money. If funded properly, a stream of tax-free income can be generated from the policy at retirement. And lastly, depending on the state within which you live, cash values can be protected against the claims of creditors. To some extent, people have a need for one or a few, if not all 5 of these utilities. So when we're building a comprehensive approach to wealth management, we have to keep these in mind.
Well, that does sound interesting, and I'm sure our viewers will be interested to hear your thoughts on how this tool can serve several purposes from within a comprehensive plan. So what exactly is an economic footprint, and how does this involve life insurance?
Sure. Before I get into that detail, though, you just touched on a word that I think is important here. You called it a tool, and you're exactly right. As a financial planner, I have an open architecture box of tools at my disposal. To anyone watching this video, when was the last time you tackled a home improvement project with just one tool? I've never done that personally. Usually we're leveraging the utility of a hammer, saw, pliers, as we are working on the tasks at hand. If the task at hand calls for the driving of a nail, then I have a tool designed just for that purpose. Nothing wrong with the screwdriver. It's just not going to help me drive a 10-penny nail. Okay, you get the analogy. A product agnostic manager of wealth not only has a wide array of tools from which to choose, but also the knowledge and expertise to know when to use what tool and why. So let's talk about the life insurance hammer. First, it's a death benefit. Now that's pretty straightforward. Sometimes people enroll in their employer's guaranteed standard issue term plan and only elect coverage limits sufficient to indemnify a spouse from carrying a mortgage, for example, or to fulfill a young child's college plan. It's easy, right? Payroll deduction premium, out of sight, out of mind, and so forth. Sometimes, though, a person might find better rates after going through individual underwriting rather than being one of 1,000 people in a guaranteed standard risk pool. So my first recommendation would be that before you sign up for such coverage at work, evaluate your individually held options first. Second, think of the death benefit itself. It's not just about satisfying a mortgage. What about your economic footprint? Consider a 45-year-old person with a $150,000 net household income. If that person dies, then okay, the spouse pays off the mortgage, but then what? If we had a death benefit of $3 million at death, let's assume that surviving spouse could invest those proceeds into a state-specific double tax-free municipal bond issue at 5% hypothetically. Okay, then we've just replaced the $150,000 of net after-tax income that was lost at the death of the spouse, correct? Often I'm asked, is life insurance worth taking into retirement? My mortgage is paid off, I have no debt, right? So why do I need life insurance? Well, as part of my planning output, I've assumed that you and your spouse would fall off the edge of the commissioner's table at the same time. What if that doesn't happen? At the first death, the surviving spouse gets to keep the higher of the two streams of Social Security income, but you lose the lower of the two Social Security incomes. How do we solve for that? Let's assume that the lower of the two Social Security streams of income was $25,000. Okay, I need a $500,000 death benefit policy so that the survivor can potentially invest those proceeds into a state-specific, double tax-free municipal bond issue at a hypothetical 5% yield to replace that $25,000 of durable tax-free income. That is replacing an economic footprint and why life insurance should be part of a multifaceted retirement plan. Beyond that, the second utility of life insurance is that hybrid policies serve two roles. It's not just about a death benefit, but also a surrogate for meeting potential long-term care expenses. There are many structures from which to choose, but in general, if an insured is unable to perform two or more activities of daily living, a percentage of the death benefit becomes payable as chronic illness benefit over a specified number of years. Now, it's not a perfect alternative to traditional long-term care, but often it can be easier to underwrite and less costly. And furthermore, just because you're unable to perform activities of daily living doesn't necessarily mean that you're receiving skilled nursing care in home or confined to a facility. So it can be easier to trigger a benefit from a hybrid life insurance policy as well.
Well, I've never thought about life insurance in those terms before, but I can see what you're saying about it being more than just the payment of a death benefit. Well, David, you've also mentioned that life insurance can be part of a retirement strategy, providing a silo of safe money and a tax-favored income. Can you elaborate more on how life insurance provides these benefits?
Absolutely. First, when I use the term safe, I'm drawing reference to a universal life, indexed universal life, or a whole life type of policy where values of cash are guaranteed by the strength of the insurance company and the solvency of its general account. Within previous videos, we talked about how earlier this year, between the 20th of February and the 20th of April, we experienced the fastest 21% drawdown in any rolling 8-week period of time in 100 years. Well, because cash values within a universal life policy, an indexed universal life policy, or a whole life policy are guaranteed by the company issuing the policy, these values remained unchanged during this time of market upheaval. Much like a 401k or an IRA, the government imposes limits on how much premium can be paid into a life insurance policy because of the tax preferential treatment that is afforded to cash value accumulations within the policy. When funded properly and to the maximum allowable threshold, a policy's cash value can do much to dilute the holistic volatility of a client's portfolio. Said another way, I may have a client with a 401k and a brokerage account and a Roth IRA, and within those accounts we're pursuing growth targets and assuming risk. Well, if I have a well-funded, principally guaranteed tax shelter in this mix as well, when I consider the entirety of all assets, the overall portfolio volatility drops if I have money allocated to a principally guaranteed platform like this. As a retirement tool, I found that many people aren't aware that it is possible to take a tax-free income from the policy. Now, this has been a common planning practice among those of higher net worth for decades, particularly from within non-qualified deferred compensation plans. The good news is that anyone can leverage their permanent life insurance to accomplish the same thing. You don't have to be a highly compensated and restricted participant of a non-safe harbor 401k to employ this as a planning tactic. At a high level, the client in this situation would pay premiums into their policy at just under TAMRA limits. TAMRA is an acronym that stands for the Technical and Miscellaneous Revenue Act. This and other restrictions came about in the early 1980s as an effort to put limits on the amount of premium that could be paid into a cash value building life insurance policy and continue to enjoy the preferential treatment of the accumulations under the tax code. At retirement, a client begins to take withdrawals from the policy. These withdrawals are considered a distribution of the after-tax basis or premiums paid into the policy. Once the basis has been dispersed, a series of loans will be taken from the policy. And at the death of the insured, all of the outstanding loans are satisfied by the tax-free death benefit of the policy. Okay, well, when I'm 87 years of age, maybe I don't need as much death benefit as I did when I was 45, but now I need a Roth-like stream of income. It is the unique, favorable tax treatment afforded to the life insurance that makes this happen. One caveat, keep in mind that loans and withdrawals will lower the death benefit. And if it's excessive, it could cause the policy to lapse, which is why it's important to work with a competent financial planner when employing this strategy.
Well, that's very interesting. I wasn't aware that life insurance could be such a versatile tool. Okay, last question. You mentioned that life insurance can also provide protection against the claims of creditors. What conditions must be met in order for someone to benefit from life insurance in this way?
Great question. So first, this varies by state. In the state of Alabama, for example, I'm referencing code sections 6-10-8 and 27-14-29B. An insured has an unlimited protection against the claims of creditors if the beneficiary of the policy is either the spouse, the children, or dependents of the insured. Again, this differs by state. So, for example, in the state of Nebraska, I'm referencing statute 44-371, subsection 1, parts A and B. Cash values are exempt from the claims of creditors up to $100,000 if the beneficiary is not the insured or the insured's estate. The death benefit is also exempt from the claims of creditors of the insured or that of the beneficiary if the beneficiary is not the insured or the insured's estate, or if the beneficiary is related to the insured by blood or marriage. From a practical perspective, many of my clients of higher net worth who might work in a highly litigious occupational field have funded their life insurance policies to a maximum extent for this reason. It provides another layer of protection against claims of creditors that might arise in the future. For this utility, I would encourage your viewers to consult with their legal professionals to determine the exact extent that this protection might be afforded within their states of residence.
Well, David, this has been really interesting. I'm sure that many of our viewers have never understood the utility of life insurance as you've described it today. So in closing, what final thoughts could you share about leveraging life insurance into a comprehensive plan for wealth management?
Simply this, it's a tool, just like a mutual fund, a stock, a bond, an ETF, annuity, or any other financial instrument. It's a tool. It brings a unique utility to the task at hand for which it was particularly designed. A hammer was designed to drive a nail. A screwdriver was designed to drive a screw. There's nothing inherently wrong with either tool, but if the task at hand calls for the driving of the nail, then I'm going to leave the screwdriver in the toolbox. Life insurance is first and foremost about the death benefit. However, it has the potential to be more than that. It can be used to replace durable streams of income, replace the economic footprint of a deceased spouse. It can be a resource for meeting expenses of long-term care. It can be viewed as an integral part of your investment portfolio, as that of a principally guaranteed, tax-sheltered quasi-bond holding. It can support tax-favored income throughout retirement and protect assets from the claims of creditors. Frankly, the list goes on. We didn't have time today to talk about how life insurance can be leveraged as part of estate planning, for example. I would just encourage your viewers to not be satisfied with the $250,000 group term coverage at work. Critically assess your needs of insurance as part of a comprehensive plan for the management of wealth. Work with an advisor who can create that plan for you and demonstrate how you might benefit from leveraging these utilities of insurance within that plan.
David, as always, thank you so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trussville Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.